In January 2021, Michael Saylor stood on a stage and said something that shocked the financial world. He said he would never sell a single Bitcoin. Not one. Not if the price crashed. Not if the company needed cash. Not if every Wall Street analyst told him he was insane. His position was absolute. He called Bitcoin digital gold. He called it the apex monetary asset of human civilization. And he backed it with money. Real money. Borrowed money. Billions of it. For 4 years, that bet looked either visionary or reckless depending on which week you asked. Strategy, the company formerly known as MicroStrategy, became the single largest corporate holder of Bitcoin in the world. They accumulated over 550,000 Bitcoin. At peak prices, that stash was worth more than $50 billion. The company's stock became a proxy for Bitcoin itself. Funds that could not hold crypto directly bought Strategy instead. And then, on June 30th, 2026, the company that built its entire identity on never selling Bitcoin authorized the sale of up to $1.25 billion worth of it. That number did not come in a press release buried on a Friday afternoon. It came as part of something called the Digital Credit Capital Framework, a document that, if you read between the lines, tells you everything about what is actually happening inside the most talked about Bitcoin holding company on Earth. This is the story of how Michael Saylor's Bitcoin empire built itself, what forced it to blink, and what happens to the rest of the market when the man who said never says now. The beginning of the Strategy story starts in the summer of 2020. Bitcoin was coming off a brutal bear market. The price sat around $11,000. MicroStrategy, at the time, was a mid-sized software analytics company, not a household name, not a trillion-dollar player, just a company trying to figure out what to do with the cash sitting on its balance sheet in a world where interest rates were near zero and inflation was starting to bite. Saylor's answer was not to put the cash in bonds, not to buy back stock. He put it in Bitcoin, $250 million worth, in one transaction. The announcement shocked the market. Analysts called it reckless. The stock barely moved. Then he bought more. And more. Each time explaining the same thesis in different language. Bitcoin is the only asset that cannot be inflated away. Governments print money. Gold is difficult to move. Real estate is illiquid. Bitcoin is the hardest money ever created, and if you do not own it, you are holding a melting ice cube. The thesis resonated, not just with retail investors, with institutions. Companies started watching. Pension funds started watching. Sovereign wealth funds started quietly researching the asset class that the MicroStrategy CEO would not shut up about. By 2021, the company had renamed itself Strategy and issued new financial instruments to fund even more Bitcoin purchases. Convertible notes, preferred stock. They raised billions from investors who understood, or thought they understood, the trade they were making. They were lending money to a company whose main asset was a volatile cryptocurrency in exchange for future returns tied to that same cryptocurrency. The circular nature of the arrangement was not accidental. It was the design. Here is how it worked. Strategy issues preferred stock. Investors buy the preferred stock. Strategy takes that capital and buys Bitcoin. Bitcoin goes up. The value of Strategy's collateral rises. That higher collateral value supports the next round of preferred stock issuance, which funds more Bitcoin purchases, which drives the price up, which supports more issuance. It was not a Ponzi scheme. The underlying asset was real. Bitcoin existed. But the machine was only sustainable in one direction, up. And everyone in the room knew it. By the time 2025 arrived, Strategy's Bitcoin position was so large that any significant selling by the company itself would move the market. They had become not just the biggest holder, but a structural feature of the Bitcoin ecosystem. Every week there were reports. Strategy bought X thousand Bitcoin this week. That buying was a price floor. Institutions knew it. Retail knew it. It was baked into the market psychology. And then, the machine started to show stress. The preferred stock Strategy had issued, particularly the most recent class, called STRC, carried dividend obligations, real cash obligations. In a world where Bitcoin was rising, the dividends were manageable. The cash flows from Bitcoin appreciation, combined with capital raises, kept the machine lubricated. But preferred stock dividends do not care about Bitcoin's price. They are fixed. They show up on a schedule. And when the price of Bitcoin corrects, the ability to raise fresh capital at favorable terms compresses. By mid-2026, the STRC share price had come under pressure. That pressure was not catastrophic, but It was a signal. It told management that the market's confidence in the never-ending accumulation model was not quite as rock-solid as the public statement suggested. USD reserves needed to grow. The dividend capacity needed protecting. And so the company did what companies do when the math stops working the way it used to. They changed the model. The Digital Credit Capital Framework. That is the name Strategy gave to the policy change it announced in the final days of June 2026. The name sounds technical. It is designed to sound technical. The actual content is simple enough to fit on a napkin. Stop buying Bitcoin for now. Authorize the sale of up to $1.25 billion worth of Bitcoin. Build USD reserves up to $2.55 billion. Stabilize the STRC share price. Protect the dividend. 4 sentences. $1.25 billion. The financial media covered it as a pivot, a strategy adjustment, a mature evolution of the business model. Those descriptions are technically accurate. They are also carefully crafted to avoid the obvious question that every person who has followed Michael Saylor for the last 6 years is asking, what happened to never? Because Saylor did not say he might sell someday. He did not say selling was on the table if conditions got extreme enough. He built an entire public identity around the idea that selling was philosophically wrong. That selling Bitcoin was equivalent to trading the best asset in human history for an inferior one. He gave speeches about it. He wrote essays about it. He went on every financial podcast on the planet and repeated the same position with the same conviction: never sell. That conviction had real consequences in the market. When Saylor said it, people believed it. And that belief influenced how they thought about Bitcoin as an asset class. If the biggest institutional holder had drawn a line in the sand, never, then every retail investor, every small fund, every pension fund doing due diligence on crypto had to weigh that against their own thesis. The man holding 500,000 Bitcoin had said the exit was not an exit. Now the exit is at least partially open. The $1.25 billion authorization does not mean Strategy has already sold that amount. It is a board-approved authorization, a permission structure. The actual sales may be much smaller than the authorization, but the market does not wait for the receipts. The market prices in the possibility the moment the authorization is announced. And the possibility of Strategy, of all companies, becoming a net seller of Bitcoin, even temporarily, is a signal that every serious institutional player is processing right now. The math of why they are doing this is not mysterious. It is basic corporate finance under pressure. The STRC preferred stock carries a dividend. That dividend must be paid in cash or in STRC shares at a premium. If STRC shares are trading at a discount to where they need to be to make the share-based dividend payment efficient, Strategy has to find another way. The most direct other way is cash. To build cash, without raising new equity at unfavorable terms, you sell an asset. The only asset of consequence Strategy has is Bitcoin. So they are selling Bitcoin to pay for preferred stock dividends. Let that land. The company that said Bitcoin was the only safe haven from monetary debasement is now liquidating a portion of its Bitcoin holdings to service financial obligations created by the instruments it issued to buy Bitcoin in the first place. The circularity that built the machine is now partially running in reverse. This matters beyond Strategy's balance sheet for one specific reason. Strategy's accumulation was a psychological anchor for the Bitcoin market. The argument went, if institutions are buying and holding forever, the supply is being steadily absorbed, permanently. That permanent absorption supports higher prices. When the absorption stops, or worse, when it reverses, the psychological anchor is removed. Prices do not crash the moment an anchor is removed. Markets are not that simple. But the argument that drove a significant portion of institutional confidence in Bitcoin's upward trajectory has just been complicated, not destroyed, complicated. And Strategy is not the only thing being complicated right now. On the same day that Strategy's authorization became public, Binance, the world's largest cryptocurrency exchange by trading volume, was facing a deadline in Europe, a regulatory license expiration. Binance had until June 30th, 2026 to secure a replacement operating license in the European Union, or legally halt services to millions of European users, millions of accounts, billions in trading volume, all potentially frozen while the regulatory situation resolved. The Binance situation is not new. The exchange has spent years fighting regulatory battles across dozens of jurisdictions. It paid a $4.3 billion fine to US regulators in 2023. It has exited multiple markets, re-entered others under new legal structures, and navigated the most aggressive wave of crypto regulation in the industry's history. But Europe is not a small market. The European Union represents tens of millions of potential crypto users and a regulatory framework that is becoming the global template. If Binance cannot secure a compliant license in time, the question is not just about one exchange. It is about whether the largest player in the industry has genuinely solved its compliance problem, or whether it has been kicking the same can down the road. The optics of the two events landing on the same day are not ideal for the narrative that crypto has matured past its regulatory growing pains and is now a safe institutional asset class, Strategy saying it may sell, Binance racing a deadline in Europe, and there is one more piece. The Ethereum Foundation announced in June 2026 that it was cutting approximately 20% of its workforce and reducing its budget by roughly 40%. The Foundation, which is the non-profit organization that stewards the development of the Ethereum blockchain, had been spending at a rate of roughly 15% of its treasury assets per year. The new target is 5% by 2030. The stated reason is sustainability, building an endowment-style operating model rather than spending down reserves. That is a reasonable explanation from a governance perspective. Foundations do this. Universities do this. It is financially prudent. But context matters. The Ethereum Foundation cutting 40% of its budget is not happening in isolation. It is happening in the same week that Strategy is authorizing Bitcoin sales and Binance is fighting a European license deadline. The Ethereum Foundation announcement lands differently when you put it next to the other headlines. The message those three events send collectively is this: the entities that built and funded the crypto industry's formative decade are all making the same calculation in the same moment. The era of spending aggressively and worrying about sustainability later is over. The era of protecting what you have is beginning. That shift has implications that go beyond any single company or foundation. The original crypto bull narrative was built on scarcity and accumulation. Bitcoin's value came partly from the fact that there were only 21 million of them, and large holders were committed to never selling. Ethereum's credibility as a developer ecosystem came partly from the Ethereum Foundation's ability to fund cutting-edge research without running out of money. Exchanges like Binance created global liquidity by moving fast and dealing with regulatory problems as they came. All three of those narratives are under pressure on the same day. What does the market actually do with this? That depends entirely on which time horizon you are thinking about. In the short term, the announcement of Strategy's authorization created volatility. Anytime a seller of that size enters the picture, even as a possibility, traders reprice the asset to reflect the new supply dynamic. That repricing is not a crash. It is a correction in the probability distribution of outcomes. The expected value of Bitcoin changes, at least temporarily, when the buyer who said never says maybe. In the medium term, the picture is more nuanced. Strategy's actual Bitcoin position is enormous. Even if they sell $1.25 billion worth at current prices, they are still one of the largest corporate holders on the planet. The remaining stack is still there. The thesis is still nominally intact. Saylor has not said he is exiting Bitcoin. He has said the company needs to manage its balance sheet. Those are different statements. The long-term picture is where the most important question sits. And the question is this: was Strategy's accumulation strategy genuinely groundbreaking financial innovation, or was it a bet that worked spectacularly well until the instruments used to fund it created obligations that the underlying asset could not reliably service at every phase of its price cycle? The honest answer is that it was probably both. The innovation was real. The results were extraordinary in the years when Bitcoin was rising. The cracks appeared because the instruments, preferred stock with fixed dividend obligations, are not designed to accommodate an asset that moves 40 to 60% in either direction. When the asset goes up 40%, the instrument looks brilliant. When the asset stays flat or declines, the fixed obligations remain, and the financing gets expensive. No asset, however strong the long-term case, goes up in a straight line. Bitcoin has had multiple drawdowns of 50% or more. The model that works beautifully during the up phases requires a different plan during the down phases. The Digital Credit Capital Framework is that plan. It is pragmatic. It is also an admission. Here is what the smart money is actually watching right now. Strategy's USD reserve target of $2.55 billion is significant. That number tells you the company is not trying to survive a Bitcoin bear market by selling most of its stack. It is trying to create enough of a cash buffer to weather extended periods of price compression without being forced to sell at the worst possible moments. The goal is to make the machine more resilient, not to exit the trade. The question is whether $1.25 billion in authorized sales is enough to build that buffer, and at what price Strategy ends up selling. If Bitcoin rises while they are building the reserve, the number of Bitcoin they need to sell is smaller. If Bitcoin declines while they are selling, the reserve builds slowly, and the psychological signal to the market is worse. For everyone watching this story play out, the practical takeaways are straightforward. Strategy is not collapsing. The 500,000 plus Bitcoin they hold is still one of the most significant concentrations of digital asset wealth in institutional hands. The company is stressed, not broken. Bitcoin's price action in the next 90 days will be influenced in part by how much Strategy actually sells, at what price, and how the market reacts to each disclosure. Watch their regulatory filings. The Ethereum Foundation cuts are a signal about the broader development ecosystem. When the foundation that funds Ethereum's research and development tightens its belt by 40%, the rate of core protocol development may slow. That affects timelines for improvements that the broader decentralized finance ecosystem was counting on. Binance's European situation is a test case for whether the largest exchange in the world has genuinely built a compliant global business, or whether its regulatory story is still work in progress. The outcome in Europe will be watched by every regulator in every jurisdiction where Binance operates. And the broader story, the one that ties all three of these together, is about what happens when the companies and organizations that defined crypto's explosive growth phase start making the decisions that defined companies and organizations always make eventually. They start protecting capital instead of deploying it. That is not a death knell for the industry. Every major technology sector goes through this transition. The early days of the internet had companies burning cash at extraordinary rates. Then the survivors started building sustainable businesses. Some of those survivors went on to become the most valuable companies in human history. Crypto is in the transition. The companies that survive it will be the ones that figured out how to stay solvent through the volatile periods without losing their position. The ones that did not survive, hundreds of them already, more to come, were the ones that assumed the up phase never ends. Michael Saylor's bet on Bitcoin was not wrong. The question is whether the structure around the bet was built to last through everything Bitcoin will throw at it. The next 90 days will start to answer that.